All right. And we are live on Blockmates with Exit Liquidity. I am here with the one and only Captain Rational. And the markets are bleeding. The people, the throngs, are yelling out in concern over their bags. And I am sitting pretty in spot, waiting for the blood to subside. But I do feel there are a lot of things going on in macro world today, and somehow when all of the meme coin fervor dies off, people's willingness to listen to what's going on in macro suddenly, oh, there might be things. There might be things that matter this week. So we are here to discuss them. How are you
Meme
doing this
coins.
morning?
I'm thinking about meme coin season, which is coming to an end. Meme coins are macro, but it's not necessarily the macroeconomics, but it's socioeconomics, structure of society, which obviously is affected by demographic trends and the structure of society and the structure of the financial system that causes behaviors.
I mean, I also think that just in general, meme coins are a great measurement of liquidity because, after all, if there's not enough liquidity in the market for people to eat, they will not be bidding up your SHIB bags. I am sorry. Uh, but when there's sufficient liquidity in the market, then or even more than sufficient liquidity in the market, then we can pump up your Geo Bowden and your dog whiff hat
You know what
because
the thing is about meme coins? The bubble, the bubble and the frenzy, it doesn't mean anything. But I find it fascinating how anyone can create a currency. And I find it fascinating how, like, in the Constitution, only Treasury could coin money, and how technology has allowed the individuals to coin money. But then, what is the value? And then there's a whole conversation of what is money versus currency, and that gets complicated. But the point is, anyone could create a currency now. And that's what a simple ERC-20, it takes 30 seconds to create a currency.
yeah.
But then the fun conversation is what gives things value. And then we get into obviously what AMMs are and what
Yeah.
exchanges is and what foreign exchange FX markets are and how value really is an organic phenomena and how you could apply capital controls, buy pressure, sell pressure, and it's an
I mean,
interesting topic.
it is an interesting topic, and then there's also just the human psychological component that is mimetic desire, which is basically the psychological phenomenon that when you see somebody having something and other people having that thing and wanting that thing, it makes you want that thing, and it's something sort of innate to humans, and we can't really help it. And when you see these memes start up and the sort of like culture around them forming on the lens through the world that people view, which is frequently social media like X or whatever, they see these cultures forming and they go, this looks like fun, I want to be part of it. And then this is how you end up with meme coins. People are in it for the culture, you
It's really
know.
incredible how every meme coin follows the bubble chart. It's disbelief and the blow off and then the dip and then the return to normal and then it just rolls over. It's like the condensed South Sea bubble in a week or two.
Yeah. Yeah, I mean, some of them actually have staying power though, and that's interesting as well. Like, I mean, look look at the market cap of like
Doge.
Doge and Shib. Yeah, those things they're still doing numbers.
Well, there's
So,
culture that's real, but that's kind of like a societal adoption.
Yeah.
Um, and that's going to be few things. And it's such the majority cannot participate in outperformance. The few always achieve the greatest outperformance. And that's like power laws, and that's the nature of economics. The minority outperform and the majority don't.
Yeah. Well, and here's the other thing about meme coins is that look, it takes a lot of study to be able to truly evaluate DeFi protocols and some of these like super in it for the tech protocols like the eigenlayers of the world and stuff like that. Like unless like unless you have really studied blockchain technology and economics and looked at the tokenomics, read all the documents, all these things, like you're not going to be able to make a determination as to whether this is a good investment. Uh, but if you see a dog with a hat, anybody can look at that and go, "That's adorable," and this thing has some legs. Like I think it's sort of in a way is just a more uh democratizing way of speculating than speculating on emerging technology and things like that. So it's just
I mean, they everyone makes currencies like Chuck E. Cheese. That's a currency. It's really only spendable and doesn't have value outside of its ecosystem. But I think we're, the whole bank money and how a Chase dollar is a Citibank dollar is an HSB dollar. I think we're on the verge of corporate currencies and the emergence or the dilution of the concept of a currency and how it can only be really created by nation states. The whole restricting or the attempt to constrain uh, the capacity to control at the government level. The whole nature of society right now is fighting that centralization, like take away their power, and that's really what this whole revolution is attempting to be. And that's what the meme coins are: is to be able to create this and
yeah, for
ultimately
sure.
stable coins take away their power.
Yeah, and I think some of it too is you always hear about like this sort of financial nihilism, right? That sort of permeates my generation and those behind me, Gen Z, and you know, to what extent Alpha is really even involved at this point, I'm not sure, but like the that nihilism, I mean, I think it comes from this sort of inherent understanding that you do have this sort of entrenched oligarchy that's sort of reaping the benefits of standing close to the money printer. and and they have all these abilities to kind of extract rents in the market that is I think probably a large component of why you have such large income gaps and wealth disparities. And so I think to some extent this is just a natural reaction to that, in that people want to be able to get in early and to be able to extract from
Their
the
own
market. They
piece.
want to stand right by this other money printer. And then if their money printer is more popular, then they're going to make money. And it's it it really is just uh as much a cultural thing as it is a it's a cultural reaction to the broader issues that we have in society right now.
I think the breakdown or the decline of individual uh, c- productive capacity or productive as that translates into their potential income is past the threshold. I think it's the combination of that and the tax level across, you know, Europe and the U.S. and the higher tax revenue societies. So the higher tax revenue societies, there's that curve where it's basically like a bell curve. You could tax, 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 and they're making more revenue. But once you get a point where you're taxing too much, then the game isn't it's tax evasion at the societal level, and you get a decline in tax revenue. But so we were at that threshold, I think, as a society. And then to top it all off, then individual income capacity started to decline, and that just pushed everyone over the edge. And now they need a way to vent and a way to try and outperform, and that's why these types of technologies are taking off.
Yeah.
I mean,
Yeah.
I mean, their rent is so through the roof. They collect rent on everything, and it's a whole conversation unto itself. Taxes at the local versus the federal level, and it just ticks everyone off, the insider trading in Congress.
Yep.
It's so blatant and apparent. What's going on there?
Yeah, 100%. Like there is just this sort of fourth turning sort of vibe that permeates everything that's going on. People just have less faith in institutions, and they are finding themselves fighting over a smaller and smaller piece of the pie, and they get mad, and so then they just at a certain point they just try to opt out, and that's kind of what crypto has been all about. That's why I think, it's been such a cultural phenomenon in and of itself, is because it's something that everyone can get behind as a beacon of hope, uh, in a world where people feel like their institutions are failing them.
Like really, the the whole maximalist thing where Bitcoin is the payment money or the money, it's so short-sighted because what is potentially to emerge with smart contracts, especially smart contracts on top of Bitcoin used for consensus and security, is exactly that sentiment. You can't, money doesn't fix the financial system.
No.
Because there's zero growth with just money. It's credit which gives opportunity, where an entrepreneur can take the risk to build a business and they don't have the money, but they can get credit and borrow a liability against money. And, and then the whole construct emerges where that opportunity
Right.
gets,
And the thing about credit is, what is the central component of credit, especially uncollateralized credit?
trust.
Bingo. So if you don't have trust in your institutions to distribute in a fair and equitable manner, you do lose uh that, you know, uncollateralized lending. And I think that much of the uh gains that we saw in the last century had to do with that growth of trust. As trust grows in institutions and stuff, it allows for more and more of that sort of lending that allows people to grow the pie rather than see it shrink. And the problem was that eventually that went poorly because credit grew too big. There was too much trust relative to the amount of trust that was deserved. And everything collapsed, and that was the 2008 financial crisis. And after that, regulators clamped down on the ability of financial institutions to issue uncollateralized lending, and financial institutions themselves no longer wanted to have counterparties uh, that
Uncollateralized counterparties.
they were uncollateralized with. They needed to be able to hedge, and so they needed the collateral. And so that's why, I mean, between that and the low interest rates that were held down after the financial crisis, basically killed off both money printers with one stone. There are two main money printers in this world. There is the one that we all see and know about in the visual financial spectrum, that is the Treasury and the Fed working to uh, issue domestic currency and bank reserves and everything that takes place within the banking system. And then there is the private credit markets
Which is the
that
people.
which operate in the global eurodollar system. They print money based off of, I get some treasuries,
It's
I
bank
make
money.
some dollar liabilities, and then those two money printers, we managed to shut them both off after the global financial crisis, because the regulations managed to squeeze the banks to keep them from growing credit, and then the low interest rates managed to kill off the broader eurodollar one. And the thing that I think everyone is missing here is that we get so myopically focused on the the Fed's raising rates, that is tightening monetary policy. No, you are tightening domestic monetary policy. Why do you think your dog coins are going ham? It's because that overseas dollar printer has been going bananas. I mean, raising rates actually increases the incentive of non-bank lenders to issue dollar liabilities. And so they've been doing that like crazy. Like crazy. And the Treasury's been helping by shoving as many treasuries out the door as they possibly can. And so between the combination of the Treasury pushing all these treasuries out into the non-banking world, and the rates being sky high so you can issue tons of dollar liabilities at a nice spread, it's been making that's why Bitcoin's gone crazy. And that is why stocks have gone crazy. And the thing is, like, why do you think inflation is printing the way the way it is? Let me just pull up a chart real quick, just because it's relevant. But here's oil. I mean, everybody's talking about how the Fed has licked inflation with their high interest rates, but no. This was just them drawing down the SPR, and this is, interest rates have been up only this entire year. So um what explains that,
If you look at if you it's the monthly good time frame. So from an average price perspective, I look at breaches to the downside and breaches to the upside as deviations from the mean, and everything regresses to the mean. We're at about average. So if you just literally inspect not the price point but the trend line, it looks like we're at a relatively uh, inclined rate of growth. So oil up means the system is working, means there's demand because there's productivity and people are able to pay those higher prices. So
Yeah.
oil too high and it breaks things too low, then that's just the nature of economics when you get
Yeah.
those price divergences or aberrations. So
What?
right now it looks like there's a nice recovery and oil prices are relatively healthy. Let's hope
Yeah.
they don't get too expensive, and that means the economy is getting ahead of itself relative to production capacity.
Yeah, because I mean, what happens when oil gets too expensive is, I mean, for a lot of industries, energy costs are sort of a fixed cost, right? Like, and the economic way of saying that is the demand is relatively inelastic. No matter what price oil is, it takes a lot for oil prices to get to the place where you get demand destruction, where people are just like, I can't pay to drive around anymore. I'm not going to go visit my buddy. And I mean, it takes a lot to get to that place. And so, um, it's just not what happens is the world just needs more dollars to do the production that it wants to do. And if those dollars are going to oil, they're not going to something else. And if they're not going to something else, then you get these shortages of dollars. And that's why this peaks right about the same time that you saw the DXY go bananas. Oh, I don't have that one up. Hold on a second. Let me pull up the old DXY. Boom. All right. So like DXY peaked in September, which is 3 months after oil peaked. But like those energy costs, they pull liquidity from the system. They pull liquidity from the system that would be used to service dollar denominated debts. And if you can't service your dollar denominated debts, then it causes
You
other
have no
problems.
business.
And the other thing that happens is like countries need to import oil, right? And so if if they're not able to import enough, there is then this like desire to uh devalue their currencies to try to buy more oil because they need the oil in order for their economy to survive. And so they try running deficits and doing other things that impact their currencies, which is what drives the DXY up. It's that need for oil because no economy can survive without energy.
Are they going to have to devalue? Is the U.S. going to have to push down the DXY? I see the DXY and I see geopolitical collusion because it's not just currency and the relative demand for supplies and goods and supplies and services, but it's also politics.
I you know I'm not sure how many bullets are in that chamber. I
Yeah.
mean, I know that they successfully did it here because nothing at all was natural about the way that this fell off here.
Mm.
Um, but I have to imagine they still have some bullets left in the chamber.
I would imagine they want to avoid conflict. It's gonna, it's murky and complicated
Yeah,
up in Russia, but they don't want China and so on and
no,
so forth.
no, and but to some extent, I think part of the reason the DXY has been allowed to sit where it has is, I mean, A, through the managing of currencies,
Mm.
and then B, in order to keep the screws on China, keep the screws on Russia. I mean, that is going to be a headwind for them. Their economy is having great difficulties. Both of them have their own problems. I mean, Russia keeps getting their refineries blown up, and they're very very dependent on energy exports.
China's in deflation.
Yep. And then um China is in deep deflation with all of the Evergrande and the property values plummeting. And
Oh, they're suing Evergrande for fraud, for the biggest
yeah,
fraud
it was the
ever.
biggest fraud of all time. What was it?
Yeah,
76
76 bill.
billion? Yeah.
So you got to remember, like inflation implies a strong economy. Implies that demand exceeds available supply. It means, holy shit, people, as much as we complain in social media, on average, the population has enough money to outpace available supply. So it implies strength. or consumer price inflation to be specific.
Yeah, I mean the CPI has continued to show strength. Demand has continued to exist because of all the liquidity that's washing around. I mean it keeps everything buoyant for now. Um,
But
the,
liquidity got the interesting thing about liquidity with regard to like food prices. Yeah, I understand what they did in 2020 and people got $800. Like, yeah, that's going to create some distortions, but the only thing that's supporting food prices is people working, getting a paycheck, and an imbalance with available supply. It's not
yeah,
like the general
that's fair.
public's getting a constant deposit. It's not like there's a distribution of currency or a printing of currency that's going into bank accounts to pay for food. I guess then again that brings up like social programs like welfare and stuff like that
Yeah,
because that is.
to your point, I mean, this sort of global liquidity stuff definitely has a lot more to do with global asset prices than
Yep.
it does with anything else, which is why QE has been such a failure, which is why everyone is so upset ever since the global financial crisis, because we have managed to distort asset prices
Mm,
in a way that is so different than the average person experiences their own well-being and financial, well-being. Because I mean, the amount of stocks that are concentrated within, the top 5%,
oh my God.
you know, it's crazy how concentrated that has gotten. So, it's no surprise. Um, let's move
What
on to
if
some.
the
Oh, okay,
what
go ahead.
what if the U.S. and the dollar rolls over? And I'm saying this obviously as Japan, as USD JPY is at 150.75.
Yeah, let me
Well,
let me
let's say
pull that chart up, because that thing is going
vertical.
vertical right now, which is not what I expected, to be honest.
If they're
Um
raising rates, they should be strengthening their currency. I think this is that's a lag effect. It'll take a little bit.
well,
Okay.
maybe it's a lag effect. Maybe, I mean, the BOJ, I don't know if there is a better currency manipulator in the world than the BOJ. So it's possible that there's some coordination going on right now with this candle right here, because intuitively you would expect that if the BOJ was going to raise rates, that would pull more money in towards Japan, which means the selling of dollars, the buying of yen. And we are not seeing that. And instead, we're seeing this green candle that is honestly a little confusing. And at the same time, maybe there's something else going on here too, which is maybe this is the market recognizing that the BOJ has so much debt that their only way out of this at a non-negative interest rate is to print more money. So maybe this is second order effects at play here.
Calling bullshit.
Yeah, saying, look,
They
you can
can't
raise
raise.
rates all you want. But here's the other thing too. They actually said that they're still going to manage the long end of the curve, uh, which, that's not really ending yield curve control if you are still basically the only buyer in town on the long end of the curve.
I don't know how they're
So
going to pay for anything positive.
yeah, it's unclear, but you know, yeah,
There's
I don't know. Like here's here's the 3 month. So it's been trending up for quite some time at this point. Um, but what's interesting is right here. So maybe this is just a sell the news sort of thing too, is because you've seen this 3 month go up, 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 up. And then the last couple days, as soon as we heard yesterday that there was going to be, that they were planning on ending everything, it starts selling off and then it sold off some more today. So it's
Oh, that's
possible.
bid. That means the buyers entered the market, and frankly, with those candles on the daily, there's some big buyers, at least relative to the last year worth of lots of wicks, and that's some big activity.
Yeah. I don't know. Maybe this is just a positioning thing. That's another thing that you always have to take into account is that anytime a big piece of macro news drops, unless you have an understanding of what the market positioning is,
Mm.
you can't. And this is not just true for macro, like this is true for earnings. This is true for everything. Unless you have an understanding of market positioning, you can't predict how uh people are going to react to a given piece of news.
Because it's
Like
relative to positioning.
it's all relative. Everything is relative to positioning. Is like positioning and liquidity are the two biggest forces in markets.
Because
If
people like to catch
everybody is
people.
if everybody is levered up in one direction, there's only one way things can go. Gravity will pull it there. And if everybody is levered the other direction and then some news drops, you can see it go the other way. So like, I honestly think that like the three biggest forces in markets are liquidity, positioning, and market structure. And that's sort of what we like to talk about here is like a lot of like the market structure type stuff, which is like talking about uh you know how the financial system is actually built and where the money's coming from and what it like all the plumbing stuff. It matters. Understanding how the market actually operates can give you insights into what it's going to do in a given situation.
So what's the biggest structure? It's if the U.S. if the dollar weakens and the DXY starts a secular decline, which technically you're looking from a 6 month or a yearly chart of the DXY, how can it not? Um, the most interesting implication is China has to weaken the crap out of their currency because they're an exporting nation and they need a weak currency for those exports to make sense.
Yeah, the problem with that China has is, yes, as an exporting nation, they would like to weaken their currency in order to increase exports. However, their dollar denominated debts are massive. And so that creates a sort of push pull there because if they weaken their currency relative to the dollars, it's going to make those dollars
More expensive.
more expensive. And they're already having dollar shortages in China. Like there are days where like the FX desks in China, they just go, sorry, come back tomorrow because they're like, we need to ration the dollars that we have over here. And it's, this is the ultimate currency trilemma, right? You can defend the currency, you can defend the bonds, or you can have free flowing capital. They've already cut off the free flowing capital. They have capital controls up the waz. So now the choice is really left: do you defend the currency or do you defend the bonds? And you know there's already very little demand for Chinese bonds. So I think they're just going to have a bad time.
Complicated. But what I do know is this is going to be a hell of a year. And if what when the world is flooded with U.S. on the run treasuries, which is going to happen.
It's going to happen in the long to medium term.
All right, this year, that's short term.
Yeah, yeah. Well, yeah, I guess it depends on your time frame, but I would say in the next few months, I would consider the next few months to be short term. Um, and in the next few months, you have um, tax receipts. Tax receipts are here. Actually, this is a great time to pull up. Here is the TGA, which is the Treasury General Account
Big money.
at the Federal Reserve. This is basically all the money that Janet's got sitting off to the side, waiting to pay some bills. And as tax season comes, April 15th is tax day. This thing fills up. And as that happens, it pulls liquidity out of the market. But the other thing that it does is um, it reduces when this is full, it reduces the need to issue treasuries um, temporarily, right?
Part of the equation, refinancing is all in another category.
Right. I mean, there's always a certain amount of like sort of maintenance level issuance that happens where,
Yeah, but nothing like this year. There's nothing in the history of global financials that compares to 2024 and the amount of treasuries that are going to come out of the United States Treasury just for refinancing. Nothing compared. It's gonna. It is. It's happening. It's this year, and it's
it,
gonna.
it will be, but every I think they are going to do everything in their power. Well, maybe they will be using it to juice the international money printer right before the elections.
I don't know,
I don't
juice
know
or not.
exactly how they're gonna issue it, and I haven't looked deeply enough at like the QRA to see like what the plan is going forward. But
It's a reductionist perspective. If they owe this year $10.8 trillion, they have to pay cash. No, not cash. You know what I mean. They have to pay $10.8 trillion. That means out of Treasury, there needs to be $10.8 trillion worth of auction. And that means $10.8 trillion worth of fresh Treasury shit is coming out of the
yeah,
Treasury Department.
that's fair. That's fair. And looking at the numbers here, 770 billion in the TGA. Uh,
They're flush.
they're flush. They're
Everything they get
flush
from
right
tax
now.
receipts, they're going to be spending every dollar from tax receipts because they don't need it. They got $700 billion.
This will last them for a little while. The other big pot of money that's sitting out there is this. This is the RRP, which is the reverse repo facility at the Fed. It has been down only, kind of following this trend line, um, but it's been kind of creeping upward lately,
Mm.
and it's possible that some of this is also tax related. Um, there may be banks and corporations that are looking to. We are getting to quarter end, right? Or yeah, we're getting to quarter end right now. A lot of times at the end of the quarter, the RRP will pump up because people want to make their books look good. I mean, they will do what's called window dressing, where they take all their longer duration stuff, or not all their longer duration stuff, but they just put a bunch of money into this overnight facility at the Fed. That way, there's this calculation called the weighted average maturity that they have to show to regulators and stuff. And it makes your books look better if you can weight everything a little heavier to the overnight duration versus longer duration by putting a bunch of money in the Fed. And so I think that may be some of what's happening. And you're probably going to see this thing go up a little bit as we get into next week. You're going to see the RRP build up even more, which is probably going to be a headwind to markets just for the next week or so, as money is pulled up out and kind of put into these sort of placeholder places, in order to prep for quarter end and tax payments.
What
So
if you add RRP and money markets?
I actually think I have, oh wait, no, this is what I have. Yeah, yes. So this is a chart I have that is
Very much
adding
thing
up
like,
RRP, money markets, and um, bank reserves.
so this is public, private sector, private liquidity.
So it's kind of looking at like,
This is
um,
spending cash.
well, it's looking at, so the so the bank reserves plus the RRP are kind of looking at like the amount of money that's sort of sitting on the sidelines in the domestic system, and then the money market fund is kind of looking at money that's sitting externally,
Gen Pop, but international deposits into money
which
markets as
it
well.
is interesting uh that this is dropped. Let me just pull up. So this is bank reserves though. So this is domestic money um, that has made its way into the uh, the banking system, and you'll notice that this popped off right as SVB was happening. Things got pushed into the banking system to help recapitalize everything to keep us from blowing up again. But that's what's pumped our bags, I think, largely is having the bank reserves go up, asset prices go up. I mean, it's a
I
pretty,
think it's loosely coupled though. So my 2 cents on the correlation there is bank reserves go up, banks stop blowing up, and and that this was related to volatility. So if the not allowing the banks to blow up is the suppression of volatility because and that suppresses fear, and calm reemerges in the market, and capital deployment occurs after a period of time, that calm is allowed to stabilize.
yeah. I mean, if you look though, like look at the dates when this sort of stuff bottoms, right? September 2019, that was the repocalypse when the repo market blew up in 2019. Uh, this was right when we started, I think QE2, or actually no, that was QE3, I think, and this was QE2, and that was QE. Like is when this thing pops off. So in general, bank reserves are 100% a function of Fed action, and this right here is the BTFP. This is when the bank term funding program was created to stave off all the issues with banks holding treasuries that the Fed had devalued by raising rates as high and as quickly as they did. And so they allowed banks to borrow against them at par. And they did. And then that sort of recapitalized or reliquified these assets. So, you know, I think it does loosely. I mean, this is what people have been saying though for the last few years, is that the Fed has become such a strong force in the market that if the Fed's doing stuff, just hit the green button. Let's go.
because it calms the market. There's the lender of last resort. It's not necessarily a put where they're actually taking financial action. It's just the perception
Well, they
that
are.
they're there.
I
Indeed,
mean,
it's even
they
more
are
the case.
because what the effect that BTFP had, and this is why I always argue with people on Twitter about whether or not it was QE, because to my mind it was QE. The who the buyers and sellers were was slightly different, but the market function was exactly the same, because you had a bunch of banks that were going to have to sell treasuries,
Mm.
and instead the Fed says, no, 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 don't sell those. Lend them to me at par. I'll give you the money. And so, functionally, what is the difference between somebody giving money in the form of bank reserves and not selling a treasury versus the Fed buying a treasury and giving bank reserves? Like, to me, it's the same thing. You're taking money from the future, which is what a bond or a treasury is. It's future dollars, and you're pulling that money forward through the course of a lending facility. I mean, sounds like QE to me. So basically, bank reserves are just QE, 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 boom.
Was
Oh,
there a distinction though?
repo market, boom, QE.
But BTFP wasn't reserves. Were they were giving dollars because they needed to facilitate
Right, but they were bank
outflow.
reserves. They were bank reserves. They needed, the banks themselves needed reserves to be able to meet the outflows.
Was it
And
reserves to meet the outflows? Because they literally needed cash to
right.
pay the
Right,
exiting
but that's
capital.
what the reserves are. I mean, it's the banks, like, cash that they have to pay when people want to leave to go to out to money market funds or whatever. They have
True.
liabilities that they need to cover. And so that's, I mean, every single one of these things is just, this was not QE2 at in September 19. Oh, it was just the repo market seized up because of reasons, and we just stepped in there, and then we uh you know did some QE, and it was fine.
Look at the dip in March of 2020. It was such a tiny dip. May of 2020.
Oh, May of 2020. Yeah.
Basically, COVID season, and that was such a dip. I mean, small, microscopic relative to what they had to do in response to the repo meltdown, and
Yeah.
then that's what caused the panic.
Right. Right. Is everyone, again, I mean, there was a huge demand for cash. I mean, there's a reason they call it the dash for cash, because all of a sudden everyone went super risk off. I need cash. I don't know, like, companies were drawing down their credit lines. Companies were tapping every single credit they had available to them with the banks, and you know, basically their reserves just dipped
Yeah, but that's
tremendously.
so small. It's such a small dip. In fact, the dip from literally just the top at the end of 2021, which was organic, it wasn't like it wasn't COVID or
Well, I guess I shouldn't say that their reserves dipped, because what happened really, because when a bank extends a credit, right? Like, they're making money out of thin air. They have this open credit line. They just weren't expecting everyone to call on it at once. But when they issue you that credit, like, as if I'm a corporation, right? And I go, "Hey, I need to call in my credit line. I need you to lend me this much money." They just put that money in the account, and it's a liability, which then turns into a bank deposit, which is going to show up in your reserves until you spend it. And so I think that's really why it was a small dip, because there was a huge amount of because some of this I think was just the QE part of it, and some of it also was that it was corporations going, "Whoa, this COVID thing is happening. I don't know what's going on. I have no idea how this is going to play out. We need to get some cash just in case, and so that way we can, you know, make sure that we have it, make sure we shore everything up, because I have no idea what's going to happen." And then what ended up happening is very little of that credit was actually deployed. And it just kind of sat in bank accounts. And that's also what caused the giant problem that that the banks had, that caused SVB to fail, was that there was all of a sudden bank reserves went from here to here. And when you as a bank have a liability, you have to have an asset on the other side. So what did they do? Some of them bought treasuries at the absolute pico top.
Mm.
They go, let's go to the US 10-year, which runs the show. Where was the US 10-year right
Oh
at
my
that
God.
time? At the
Pico.
generational bottom, literal generational bottom. They deployed $2 trillion into this. And then the Fed hiked rates at the highest rate like ever seen. And then they wonder why all the banks are in bad shape. You just killed them.
Look at
Like
that chart, man.
it's
That
like
chart's
that meme where
spectacular.
he turns around and shoots the guy and goes, I can't believe the market, I can't believe the banks did this.
Yeah, the banks, the central banks.
Yeah. Yeah, for sure. But I mean,
Protected.
that is what caused all of that. But
That
doesn't really
chart's
help us explain
astounding.
where we are now, but it is useful color on what it was that exactly transpired, because the story I just gave has little to do with the mainstream story of what happened, because the mainstream story is that the banks were reckless and they did all this stuff. And honestly, think about like commercial real estate and stuff too. Like, not all of that money, not all of that 2 trillion went into treasuries.
They were lending at
I mean,
Silicon Valley.
some of it was lending. They go, I have these liabilities. I need to make some assets right now. And so what does a bank do when it needs an asset? It makes a loan.
Mm.
It makes a loan. It refinances some stuff. It pushes out duration. And then you go through the biggest punishment of duration in the history of the United States right after that. And then you wonder why you're having issues. And so there are cracks. There are cracks in the macro foundation right now because of the actions that took place when we were down here, like, or the actions that pushed us down here. I mean, some of it goes way back, but we made lots of big mistakes right here. And we're going to be paying for those for years. Years. And I think that the Fed is just now starting to realize, and in fact, I saw something today that the Fed is starting to walk back all the Basel in-game nonsense. You're hearing talks about SLR being changed. Now, for the uninitiated, the SLR is the supplementary leverage ratio. So basically, after the financial crisis, the banks were required to there was these leverage ratios that were installed to help secure the financial system. And it's to prevent banks from getting super over leveraged, right? And so that all sounds well and good, but the problem is they applied those leverage ratios to treasuries as well. And so what happened was banks suddenly became super constrained on their balance sheets. So that is why you had such sluggish growth coming out of the global financial crisis, because banks literally could not lend as much as they want to. They couldn't put as much money into the market. They could not expand their balance sheets as much as they wanted to. It didn't matter whether they were holding like garbage or treasuries, they were still limited in their ability to create money. And if you push down on the ability to create money by keeping interest rates super low and capping domestic banks' ability to just make money out of thin air, there's just not going to be enough money. And then you're going to have sluggish global growth. And that's what happened.
Now they need to
But
turn them into recyclers.
but now what's happening is they see the deflationary bomb coming, and they are trying to find inflationary counterattacks.
If the banks, if the SLRs adjusted and the banks could assimilate or sterilize this supply, but that's also going to give them a lot of firepower to spend into the real economy, or extend credit into the real economy.
Right. So that is the other part of this, is removing the SLR from treasuries is also going to solve the treasuries problem of who's going to buy the treasuries, because they're going to be issuing like crazy over the next few years.
1 year.
I mean, it's not going to stop after one.
No, but
But like,
that's the thing. The whole cycle that has emerged, this 3.5 to 4 year cycle, it's this year, and the amount that has to be absorbed this year by offshore and onshore parties is the largest amount of treasury issuance in history. It makes 2020 seem seem like it was big, but it's not as big as what's playing out this year.
yeah, yeah,
They were at the deficit run rate. $13.9 trillion is coming out of the United States Treasury this year.
yep. And this is where it's been going, right into money market funds. But the thing is, at a certain point, um, this trend could reverse. It's happened in the past. January 09, October 01. So basically what happens when the global liquidity bubble pops, people start drawing down those money market funds, and they start onshoring that money again, bringing it back and putting it back into the economy. Um, and when that happens, what do those money market funds have to do?
Go bankrupt.
Well, they got to sell off the treasuries so they have some
Well,
dollar liabilities to to pay for it. And so that could get very interesting. And if they don't have an answer for who's going to buy them when that happens, they're going to have a bad time.
that's
Um,
when interest rates go absolutely, everything gets all wacky.
yeah, everything's and that's not what they want, because then the you might have like a for real debt crisis like in the United States,
Well, there's no
which,
debt because then they just buy it all at the Fed, and
well,
then
they would go the Japan route, right? And they would just become the market
yeah,
for the treasuries. But the thing is, they don't want that. They would rather do it through the private sector. And what better way to do that is to undo the dumb stuff they did in global financial crisis and turn off the SLR for treasuries. That way, what happens is it gives banks the ability to arbitrage using treasuries infinitely. They can expand their balance sheet to buy as many treasuries as they want.
but then they also have to, now they have to extend credit, which distorts the real economy and applies. They want the growth. The government wants the growth. They want the tax receipts, but they don't want the consumer price inflationary pressures. Catch
Yeah.
22.
Yeah, it is. It is a catch 22. And ultimately, I think they know, I think I think everybody watching this stream knows that the only way out of this is not through tightening the belt and, paying down the debt. It's going to be inflating away the debt. Like, that is the only politically viable way out of this mess for them. And they know it.
And
And
so, and the
so,
inflation, the art of the inflation from a political optics standpoint is to constrain inflation. It's like sequester it. So the sequestering of inflation is to keep it out of what the public inspect, which is food prices predominantly and rent. So there may be some rent controls. They're going to have a problem with real estate because if the banks need to issue credit because they have all this firepower in their balance sheet, there goes real estate prices. So,
yep.
so that we're getting to.
Ironically, it is the rent control departments in New York that are the thing no one wants to touch with a 10-foot pole right now. And why NYCB is blowing up, because that was their bread and butter, was rent control apartment lending. And nobody wants to touch that stuff because the rules are just so stupid. But yeah, I mean, that is where we stand. Can you believe there's 2,400 people watching right now? It's wild.
It's good content. As much as we love our meme coins, it's imperative to understand where we are in the financial system and how it's going to play out. This is the path leading
This
towards
is
the destination. I still see the destination unchanged, no matter how much we talk about macroeconomics. I see this as a path conversation, but the destination still is towards the end of this year, heading into Q1, Q2 of next year, is the greatest expansion of the global currency supply in the history of mankind. And it'll be dollar denominated. And it's here. It's just staring us right in the face. And all the
yeah.
complexities and nuances associated with it are intriguing to digest. But when you reduce all of the variables, all of these causalities to the only possible destination, the only possible result is the currency supply is going to expand. What do you
Yeah.
do with the collateral? There's only one. Bonds are money, and money prints currency.
Yeah. I I think it's also important to note, and this is actually a key part of my thesis that in all of the ranting I just did in the last hour, I have not really touched on, is, so we talked about how interest rates being high actually juices that global money printer. But for the sake of the solvency of our financial institutions, because of CRE, because of just all of the debt and loans that have been issued, some of which were issued at the Pico bottom. Um, because of that, the Fed and all the politicians want interest rates lower, because, I mean, there's a few reasons. One, that is what's increasing the bad experience for everyday people, is they're unable to buy a house. Like, houses are as expensive as they've like ever been. Rent starts to go up, when that happens. Like, you get these knock-on effects of high interest rates that do start to impact people. So because that is how most people get credit. They do not go into the repo market. You and I do not go into the repo market every day and then, uh, you know, you get our home loan or whatever. We go to a bank and we get a mortgage, right? And so what what the Fed needs to do from a political standpoint is to bring interest rates down. And everybody wants to see interest rates come down
You lower
because,
rates, and there goes the mortgages because now at 2% you could afford the $1 million mortgage.
well, if you look, people can start to refinance and stuff. Like it will take some of the heat off of the solvency issues of the banks right now. So I think that is the other part of this as to why they're talking about SLR, why they're talking about Basel Endgame and redoing those rules, because there's a certain uh power struggle that's going on between the Fed and these global money printers. They want to be the only money printer in town. And right now they realize that they are not. And so, but they can't just lower interest rates because they will kill the money printer. I mean, you got an election coming up. You don't want to kill the money printer without some way to print on the other side. And so they need things like the SLR. They need things like, renegotiating Basel Endgame and stuff to try to spur that domestic money printer to fill the gap. Because if they just lower interest rates, I honestly think the market will crash. The market will crash. And that's totally counterintuitive to what most people will tell you.
It's the historic norm.
It is the norm. And I think that it's the norm for a reason, because people always discount how important that global money printer is. Like the domestic money printer, everyone seems to have a vague understanding of through the media, but lower interest rates is going to crush the
Incentives for
the
international
incentives for international money printing. And what better way to get your banks back to solvency than to give them the ability to lever the fuck out of treasuries right before you're about to lower interest rates.
They're going to lower marginally. They lower 1/4%, 0.5%, just to give
But
a little bit, a little juice,
you
adjust
have
the
just
SLR.
removed any sort of restraint from them levering up on treasuries right before you shoot them into Valhalla by lowering interest rates. And so what
That'll
that
piss them off.
does is, no, it increases bank profits. Now the
Sure.
solvency issues go away.
The banks are like, if you're going to cut those rates, you sons of bitches, you better let us get in on this.
Exactly. And what better time to do what better time to remove the SLR than when interest rates are where they are, if you're going to drop them.
Now, what's
Because
fascinating is the bottom on interest rates and the whole interest rate cycle. If they lower 1/4 and 0.5%, international firepower is just going to be through the roof, considering the amount of fuel that's going to be put onto the market. Think about it like this: when all the money was printed, bonds being money in 2020, what were rates? There was no international printing firepower, but now they're about to print 10.8 plus 2024 fiscal 13.9, give or take, into a market that's 4.5% US domestic rates.
yeah, well, and that's the other part of this. The Treasury needs those rates down. Treasury needs those rates down. The banks need those rates down. But the
Get real
problem
aggressive
is the
markets.
Fed. The Fed is in trouble because the Fed is trying like hell to manufacture a tale where the conventional wisdom, which is that if you raise interest rates, it helps with inflation. And they haven't been able to spin that narrative in a way that's believable, because oil prices are still up and away. Like they're nowhere near where they were at the top, but they're definitely.
On trend.
Yeah, I
Look at the
mean,
average price. It's remarkable.
yeah, I guess they are.
Look at that,
But
smacking right into what moving average is that? Tell me it's the time weighted average price.
yes, this is
The
time
yellow
weighted.
line.
Well, the red line is I think that's a 200 day.
It's literally on trend.
Yeah. Yeah. And this is a 50-day, 100-day, and the 200 is the red.
By definition, not passing through trend and finding support, it means the market is in equilibrium. Was adequate buyers, adequate demand in the market to prevent an excessive deceleration.
Yeah. I mean, there are some sort of like geopolitical things going on with all of the Houthi bombing of tankers and stuff, and you know the bottling up of shipping lanes because of that can impact oil prices. Tankers have to be rerouted, they take less efficient routes, you get fewer uh refills, which means less oil delivered, which means less supply.
No shocks though, and you would see that for the currency
Nothing
would
yet. Nothing yet. And the thing is, if demand is also tailing off in conjunction with that, might explain why we're just chilling at the average. Um, so I don't know. I do think that there are some macro headwinds that we have here, um, with staring down the barrel of lowering interest rates, because I think politically they want to get that done before the election. Um, and like I said, I honestly think that if they lower interest rates quickly enough, it will just stop that money printer dead in its tracks
it'll blow everything up.
and blow everything up. And there's so much more to blow up now.
Yep.
That's the nature of how this works. Is you get these debt bubbles that take place in the global debt markets, and then all of a sudden the dollar goes to the moon because you've got demand for dollar liabilities. Everybody has
Fear.
dollar liabilities, and suddenly that
Fear.
external credit source dries up, and now people can't refinance as easily as they could before.
Check
And
check this out though. Check this out. Let's look at a couple more charts. Let me throw up mine.
oh, sure thing.
So, technically speaking, technicals are obviously just a part of the overall conversation, but I think at this point it's quite meaningful. This is the 3 month perspective. So we had our blow off top for the full bearish engulfing. And and you could have the macroeconomic conversation about what's going on in the world, but a bearish engulfing is indicative of reversal. Chop, spinning top, give or take. It implies indecisiveness, and these are 3 month candles. Reversal to the upside, hammer candle, indicates a bottoming pattern. And then you look for continuation to the upside. The hammer was followed by a bearish engulfing. And we're about to close in 9 days a failed bearish engulfing. And that is an inverted hammer of sorts, but it's a failed bearish engulfing. So you got literally two bearish engulfing candles in the last year and a half, two, give or take 3, 6, 9, 10, 15 months, year
Yeah.
and a half. Now it is above time weighted average price trend on the 3 months, so that is a bit concerning from a technical perspective, and that presents the entire conversation we had today of where we are. So there's a bunch of hurdles or speed bumps, or we're staring down the barrel of the world ending. But the reality is we're always staring down the barrel, and the world is always on the verge of ending. And that's why I talk so much about the dollar being a manifestation of geopolitical collusion. It's a managed economic construct, and the currencies are relative. That's why I do like to talk about the dollar and that them having to devalue to a degree. And you very nicely point out that the only way you get this kind of candle, this kind of top at the end of 21, uh, at 20, end of 22, Q4, Q3, 4, 22 is intervention. And you see that even more prominently on US dollar versus Japanese yen. But if they depreciate this by whatever means, frankly, I think that's going to be via treasury issuance with elevated interest rates. So let's say you cut a 0.25%, 0.5%, and you're flooding the market with treasuries. It's going to take pressure off dollar FX and allow foreign countries to print their dollars instead of buy their dollars.
Would it though? Because if you issue a bunch of treasuries, what do you got to buy those with?
So that presents interesting questions. How could you get your hands on treasuries not dollar denominated? So I have often thought about that. Is there a way to do that? Arbitrage or non-primary counterparties that have access to auction. So currency arbiters, they have the free balance sheet capacity to acquire at treasury, and then they're like, oh, dollar's going to roll over. Well, here, you want to buy this in yen? You want to buy this in euros? I mean, as much as is,
You can do that, but I think like just the nature of the trade though, it's sort
right.
of like it's like I think about like routing in Uniswap, right? Like if you route everything through the dollar, you still at some point in the transaction have to buy dollars, and frequently
It's someone with dollars. They have to sell them for dollars at treasury. So someone with dollars is buying this instrument, this meme coin, that someone that and they want they're and now they have something, a capacity to sell it for another currency denomination because they think that denomination is going to outperform cyclically or maybe even secularly for that matter at this point.
I don't I don't know. I don't know that I agree that the DXY is ultimately going to roll over before I actually think lowering rates is not going to have that effect on the currency. I don't know. I honestly don't know where the currency is going to head because like
No
I
one
think
does.
like I said, you've got the offshore printer is going to shut off when you do that. And
When you do what?
when you
Lower rates
lower
a quarter?
interest rate, when you lower
But but
I mean
look,
a
where's the
quarter
bottom?
it depends. I mean if you lower interest rates, right? And it even causes a little bit of liquidity globally to reduce, what's going to happen is you're going to dry up that global printer, and now other currencies are going to have to debase themselves to try to get the more dollars because they don't have the access they once did, which means relative dollar appreciation. And there's more debt in the world than there has ever been. And so I don't know. I think you're looking at more of a dollar milkshake sort of situation in the event that you lower interest rates. I think that
See,
the reason we have seen the DXY roll over from its highs in the last year and a half is that you have seen that global money printer fire up. And that has pushed the DXY down. And I think, you know, you could see it retest those highs in the event that we actually lower interest rates.
that would be wild to see the DXY retest those highs. The DXY retest those highs, that has all the implications on the oil market because or the energy market broadly, as that's dollar denominated, and that dries up capital to go into equities. And if the flows stop going into U.S. equities, those things are going to roll over real quick because breath dries up, the continued move upward dries up, and there goes fear in the market, and that's going to spiral real quick at these heights. I just I think that we have a what's his name who says the massive blow off top.
Oh,
And but
oh, what was his name? That guy is such a silly man.
yes,
Um, I know who you're talking about.
yeah, I see the greatest expansion of the global debt construct, and it's coming. And yeah, of
I
course,
mean, I
debt blows
agree.
up.
I agree that we are going to fund those liabilities, all of them, all of the liabilities, because at this point we do not have the option to be choosy about which liabilities we fund and which ones we don't. And this lies the problem with
World has
having
its debt.
a, a dollar system that is so ubiquitous and yet so like you cannot have this multi-parted dollar system because if you have the regulatory dollar system and then the unregulated dollar system, and every time the unregulated dollar system breaks we just bail it out, and so we just absorb more and more of it and distort the markets more and more. You just got to admit that it's all the same dollar system and that you don't have any control over it, and just but we don't do that. We don't do that here.
No, they don't admit it. It's always going to blow up. That's the destination.
It is
And
the destination.
but it's on the way there. It's the patchwork, and
Yep.
then that's the debt just expands more, and the global current, therefore the currency supply expands more because they were crafty enough to turn debt into currency.
And that is why you must buy Bitcoin.
I mean, that's right. But man, premium versus discount, that's still at a remarkable premium. I like that yellow trend line. That's a nice buy zone.
Yeah, for real. And remember how we were talking? Like Bitcoin was right on this line, and we were like, there could be a path where it kind of bounces around a little bit, and nope, it
It
just
just went right through.
powered right through it, and in some ways, like it's almost done like I don't know, as long as we're just penciling lines on a chart here, like
Oh dear.
I could see a world where we do something like this.
Can, can we?
You
That
know,
is that's egregious. That's chart fraud right there.
I mean, that's what I'm best at. Uh, but if you're gonna like, those are nice parallel lines, though, right? Like anytime I see these like spontaneous parallel lines appear on a chart, I tend to believe in them.
Well, there is symmetry to charts. That's a good part of
And
technical analysis.
you
I
know,
mean, it's Elliott wave.
I could see a world where we go hit up here and then maybe do some bouncing, but like we got to recover this candle here first. So
That is a shooting star. That is a reversal candle. And then the question is, where's the reverse to? And the whole nature of the market has changed with the flows. So my expectation broadly is a muted reversal. I don't care about bottoms because if you go to 64 to 58, who gives a crap? I don't
yeah,
treat it
I
as that.
I haven't sold any of my Bitcoin. I didn't sell any of my Bitcoin when it was 15K. So why would I sell it when it bottoms at 50? Uh,
It's a remarkable number. The market is at a 400% premium from bottom.
yeah. I mean, I bought
And
most of
we're
mine at 10, so I'm all right. I'll be okay.
yes, indeed. Come a long way.
Yeah,
What do I remember? I remember buying Bitcoin and Dash.
uh,
This was 280 days.
now
And then I,
sorry, I was just thinking like it is a shooting star now. We
mm,
still have the rest of the month to repair
12
this
days.
particular candle. So, uh, like I said, with the macro stuff though of tax season and end of quarter stuff, there's some headwinds there. Maybe we don't. Maybe we do like you said and have like a small retrace where we kind of piddle down here and then back up again or do something like that. I don't know. but I'm in it for the culture. I'm in it for the contra uh,
The
fiat
contrarianism.
currency. Yeah, like I think I'm in it for the uncorrelated asset when it comes to not like last time the banks failed, like during SVB, Bitcoin took off. Like bank failures, bullish, bullish for Bitcoin. So, what better way to hedge?
I just want to own a bank. That's all I want. I mean, is that just a simple
Is
thing?
that too much to ask? Yeah,
I mean, isn't
especially
that? I just want a bank to do all the work and people to borrow and lend and deposit and do all their things, and just the bank pays me. That'd be nice.
we could name our bank Exit Liquidity.
You name our bank Tapioca for all I care.
Yeah.
Dessert pudding.
That's a bank in
Listen, my friend, that's what I will write that on my tombstone. I bought a bank. I it is a bank. That is what a bank does. It's an international bank in an emerging market that it's a bank. That's exactly what you've built. That's exactly what
or
all
is
the
it
stuff is.
a non-bank?
Well, non-bank, because
It's a non-bank
because
bank.
it's to be it fits a new category because it's an emerging market accessible to all markets, but of no market.
Yeah. Yep. It
I bought a
it is.
bank on my tombstone.
I bought a bank. I bought a zoo. That's that's what most of crypto Twitter's been doing, buying zoos, animals and dogs with hats.
All right, let's do it, my friend.
All
It was a
right.
good one.
I think this was a good one. 2,600 is the final count of how many people we got on this stream. So I think
Thank you all for joining. We appreciate you.
yes, indeed. And everyone, until next time, try not to be exit liquidity.
Yes, please.
And also don't be entry liquidity for all the people that are trying to sell into this massive red candle right before it's about to reverse too. Don't be that guy.
Redefine. You have to redefine everything. And that's why we tell the stories we do. That's why my stories have been so consistent. We look at everything from a different perspective. Because it's all psyop. Everything they teach you from the general public is all within the system, but you have to think outside of the system, without the system.
Very good, man. Well, we will do this again soon, but until next time, exit liquidity out.
Peace.